All right. Good morning, everybody. Yay, we made it. GIF. So we still are in the same position we were at earlier this week. We have a complex topping pattern. We need to break into a higher high or a lower low. And until we do, we can guess which way we're going to go, but it's just a guess. We need to get out of this range. Europe up about 1%, small caps leading the way in the US at 0.5%, while the S&P, the Dow, and the Nasdaq are in the red. Not by much, but still in the red, and an odd discrepancy we don't see very often. Seeing the small caps lead once in a while isn't near necessarily all that odd, but having them completely green and up 0.5% while the rest are red, yeah, that's a weird one. So keep your eye on that dynamic. Look for it to change. Either kind of look at it like one side's lying. All right. So either the small caps are lying or confused, they're going to turn around and get into the red, or the others are going to turn around and join the small caps in the green. So one or the other. It should not stay this way all day. At the end of the day, today is OpEx. I know that might be confusing for some people, but just stick to the idea that there's billions of dollars being traded in the options market, and it's coming due, right? So a lot of times, all of that trading traps price and puts buffers around price, makes it hard for us to go higher, harder for us to go lower. And around OpEx, those options either get removed completely or they get shifted and rolled into a higher position, a lower position, and then that gives us room to move. So here we are, we've been in this complex topping pattern. We've had a real hard time getting higher or lower. And all of that's about to change. So with these roadblocks out of the way, next week, we might start to see some volatility. And that's going to be one of the things you really want to focus on, as it will help us define which direction we're going to go. So it's not really the OpEx uh, impact today that we want to worry about. It's the OpEx impact in the next 8 to 10 days. The leading indicators are a little off. See if we get anything out of that this morning. That'll be at 10 a.m. -1 versus -0.1. There's a bit of a difference. Same thing with the Philadelphia manufacturing, -4 to a -2. So we'll see if that actually comes through, or we're going to hit in line or just miss it completely. And they got a -1 here instead of a -2. So even when it comes to projections, we're getting discrepancies. Once we're through that 10 a.m. report, there really is nothing left on the table for today other than headlines. So we don't have any economic events scheduled beyond that. It would not be unusual to get a Friday afternoon data dump right before the close. So, that's always a threat we have to be concerned with. Considering how many times they've invited people who weren't supposed to be a part of the mission briefing using that new war app, media app that they keep using. I think if they do try to join in these strikes, everybody would know about it ahead of time. I think we had, what, 4 different incidents? One of them was a reporter. The call wall was moved slightly higher, and the put wall was rolled lower. Having the call wall move up a minor amount is common when we see the put wall move down. I went back and checked, so that's common. I went over to Spot Gamma and captured a picture. You guys get an idea of what I'm talking about here. I removed all the other lines and just have the call wall and the put wall here. So this little bitty bump to the upside is common when we see the put wall get rolled down. Same thing day like back here. It didn't happen on the same day, but here it did. The call wall went up, put wall went down. So it's not unusual. And the fact that it went down by itself doesn't necessarily mean anything. You can see where we had the put wall move down here and here. Call wall didn't move at all. And back here where we had the put wall move down and then it immediately went up. So, by itself, this is just one data point that they are moving the puts out of the way, the put wall, which we already knew they were going to get out of the way because it's OpEx and we're going to see that position move. Now, move by the date of expiration, sure, but also now moving it with location. If you don't have access to Spot Gamma to be able to do what I just did, every day I post the levels for Spot Gamma. You can just write the levels down and look at where they are now compared to where they were yesterday. You can always just scroll back in the chat too. I post the levels every day. So you can compare, today's post to previous posts and see if it's moved up or down. It is nice though to be able to chart them and see where they're at. So we are between the 0 gamma and the volatility trigger. We're stuck underneath the 10-period daily moving average. And one of the things that I'm looking for now that we're below the 3 and the 10 is to see the 3 cross below the 10. If we get that, it's a surge signal. Now, we haven't quite got the crossover yet. We can see here, for an example, where the 10 dropped it down, or the 3 dropped down towards the 10, but it didn't actually cross. So here we're beginning to pinch, but they haven't crossed yet. We did make a nice bounce again on that 20-period moving average. Third time's a charm, maybe. As I mentioned in the chat this morning when somebody asked where we're at, we have to get out of this. It really is just as simple as that. We got this high that we have to break or this low that we have to break. One or the other. And until we do that, we're just in this complex topping pattern. We can just chop back and forth here. We can even start to wick out of it and build a bit of a megaphone here, but we need to leave the range. Now, LRE, you're much better off trying to short it against the highs or buy it against the lows than you are trying to, sell it at the lows or buy it at the highs, right? Just from an LRE perspective, low risk entry. It's not to say that the maneuver isn't risky, right? There's risky behavior, and then there's putting money at risk. An LRE puts less money at risk, but it is still a risky behavior. The way I'd rather trade it though, all things considered, I'd rather short the highs and I'd rather buy the lows than try to sell the lows or buy the highs. Because if you're wrong, all things considered, you can just take the other side afterwards. Still have an LRE. So at GTFO, we have to get out of this box. And until we do, it's just a bunch of guessing and speculation. Now we got yields and bonds and treasuries and commodities that can all give us insight and signals. But at the end of the day, what is going to move this market? We don't know. It could be war headlines. It could be the start of a new earnings season, because we can certainly sit here until the next earnings season kicks off. We don't know. So we have to get out of this range. Volumes always get a little out of whack during OpEx, simply because we're getting transactions from a trade being moved in time, right? We're talking options and futures that expire. They have to be moved if they want to be kept. Otherwise, they're going to be closed. So it's a transaction, but they're not, quote, new trades per se, right? They're just existing money that's in the market that's being moved farther out in time. But it still counts as a trade, and it still shows up in volume, and that messes with the volume metrics. If we think about that, we should have higher volume, right? If we're getting more than the average amount of volume because we're seeing trades moved or rolled, then we should have elevated volume. We really don't, all things considered. We're at 62 today. This week we've seen 50, 62, 74, 44. So we're not really out of line. Last week we had higher at 157, 156. So we're not out of line with the overnight volume, kind of just coming in on the norm. It does show that we have a market maker move this morning, but just go ahead and ignore that. We would see that during OpEx and during the contract change, no matter what. It happens this whole week, and there's just nothing we can do about it. Most of the time, the market maker move is an excellent heads up, but in the week of OpEx, it's just completely worthless. So just ignore it. You have to ignore it the whole week. We're basically flat at this point, so there's no edge in trying to identify if we're going to go to the higher or the lower ADR half. But to get to the lower one, we can do it without really leaving the range. Now, for those who are kind of new to all of this, when we have a short week and we have a day where we got futures but not equities, you'll get the situation we had yesterday. So you do see Thursday here, but the broker isn't going to count it as Thursday, and you shouldn't either, right? Take all of that and tie it in with this morning and just count all of it as Globex. So we have Wednesday's close and we have now. And just consider all of this since Wednesday's close as Globex. I know it's a little odd in the thinking, but it helps when it lines up for the pivot points and everything else. So when we're thinking about the inside day and inside day breakout, what we have to keep in mind is Wednesday's price action. All of Wednesday's high to Wednesday's low, and then getting outside of that box. And we were outside of that box, but we're back inside again. This is what we want to keep. If you're focused on today, then you want to keep track of everything since Wednesday's close as our Globex. So a lot of times I say, what's the intraday going to look like today? It'll be sideways unless we get out of our own Globex range. That's the prevailing wisdom that we start with every day. If that's the case, when we get into the RTH today, the regular trading session, we have to get out of this range if we're going to do anything else. And to the downside, that just opens the door for us to go lower. But to the upside, if we get out of this range, we still have Wednesday to deal with. Get out of that, then we have Tuesday's high to deal with, and then the high on the week, which gets us really close to the upper ADR. Level by level. Okay. So we are outside of the Globex range. We are back inside of Wednesday's price action. That's what you would want to focus on right now. That was a really nice push, by the way. There you go. So we're already seeing capitulation from Iran when it comes to the negotiations. And the market liked it, and we're getting a bump from it. Just keep in mind, you know, they can say what they want, follow the money. So this is a good start. We'll see if it sticks. With this sort of little liquidity pop that we just got, if it doesn't stick, got a pretty good example of it right here, then we'll look to wash it back down where it started. So there's the bump, washed it back down to where it started. That would be at least 60.25 if this little bump doesn't stick. With the floor pivot for the week, we are back above again. So that was just a nice little check. Now that we're back above it, we need to keep it. Speaking of checking, we just hit the daily floor pivot, and you'll notice, maybe you'll notice, there isn't one for yesterday. It's because the broker is not counting it, right? It's tying everything up with what we had Wednesday. The channel is narrower than Wednesday. A narrow channel implies that if we break out, it can stick, but it's still a wide channel, all things considered. It could be so narrow you don't even see a channel, you just see a pink line, and it's not that narrow. A narrow channel implies if we break out, we can actually keep it and just keep going. So we did break out, we didn't keep it, we came back in, and the floor pivot lower than yesterday's floor pivot is bearish. We certainly were bearish. Now we're back, we've hit it, so we don't have an MDP. And all things considered, I wouldn't expect the SNR levels to do us any good today, but doesn't hurt to have them overhead to kind of know where they're at. 60, 67 to the upside is R1. You could consider that we were at S2, so going to an R1 kind of makes sense. If we don't count a lot of this Globex and just look at where we were this morning, then S1 to R1. And really, that could be our range for today. Remember, we're not looking for OpEx to move us today, right? That isn't supposed to be the catalyst today. We're looking for OpEx to really be the catalyst going forward starting next week. So holding the line today and just staying between the SNR level would be a healthy end to a week, right? Think about the talking heads, the bobbing heads on TV, chipping their teeth in the national narrative. Things are fine, everything's fine, right? Two thumbs up, it's all good. Going into the close, holding this range would boost that narrative. We're back inside the value area. This range here between 60.82 and 60.32. 82 used to be a valid cog line. It's not anymore, but back when we were in the 2800 and 3200, it wasn't that long ago since the ES was at 2830 and 2890. At least it doesn't feel like that long ago. Either way, now that we're back in the value area, we need to keep it. So we're hitting this high volume node at the moment, kind of struggling, right? And it shallows up. And then we've got another one where the point of control is. But this whole zone, now that we're in it, we need to keep it. We had a hard time just getting back inside it. We can see here and then again here and here, fighting to get back in the box. So we're in the box, we need to keep the box. It's unlikely that we make it through the top of the box today, right? Getting into like 6,100 by the end of the day today. It's technically possible, but it's not very likely, right? Best case scenario is we close above 60.32 cog line. Failing that cog line opens the door for 60.11. Cutting through that gets us down to 59.92 cog line and the gap close, which puts us down here at 59.78. Analysts do gaps differently. As far as I'm concerned, if that's where we closed and this is where we opened, that's the gap that needs to get fixed. And hey, to each their own, right? If other analysts don't see it that way, that's on them. It's not about right or wrong, right? It's just pick a style and stick with it. So that was cog line levels all the way back down. Break 32, get to 11, break 11 for 92, break 92 to get the gap closed at 78. Level by level by level. And if we break this low, then we target last week's low, 59.50, which is like the last line in the sand and the last defense at this point. Break 59.50 today, we're looking at 57. Be flash crash scenario. No reason to expect that, by the way, right? There's absolutely no reason to expect that right now. 10-day, 30-minute volume profile with TPO and a classic shape on the TPO. The volume profile, I mean, not so much. It certainly got the high volume node or the value area strongly centered in the middle, as we do with the TPO. There's no reason to expect the point of control to move today or even for the next few days. And when it does, it's not likely to shift very far from 60.37 up to like 60.70 area. But we've got a classic distribution. And at this point, it's a little thin across the top, so the path is easier higher, but that means nothing in the grand scheme of things, right? So it's just a little thin on the top side. We do have a little discrepancy this morning between the volume profile and the TPO. We can see more volume here, and it was done with less trades. That high volume level that we marked out was hit in the regular trading session, so we're done with it. We can take it off the table. This other one, just going to keep it. It's not a VPOC, it's just a high volume level, and I'm going to keep it for right now. The point of control from Thursday, I'm not going to mark it personally because I'm counting Thursday into today's trading session. On Thinkorswim, you can kind of do it. It's easier on TradingView. If you hand draw your volume profile and just start it from, a Thursday at 6 o'clock into right now, which you can do on Tradeovate really well, and you can do on TradingView really well. On Thinkorswim, it's doable, just a bit tricky. And that way you can put all of the profile or all of these 2 days together into one single profile. On Thinkorswim, if you're going to do it, I would advise just setting your chart to start at that point and then putting the profile on the right. do it that way. Just cut off how many candles the chart is showing, and the profile has no choice except to show you the profile for those candles. Otherwise, the textbooks would tell you to mark this value area and the point of control down here, so that if we do break to the downside, 59.83.5 would be a point of control. We don't necessarily want to call that like support or resistance, right? Because it's that implies bias. Instead, you'd be better off calling it what it is. It's the place where the greatest amount of volume took place, and we have an expectation that if price was to go back there again, there'd be some trader's remorse. Maybe people bought there who ain't happy and now we're back, or people sold there and they're not happy because now we're back. So, if that's where the greatest amount of trading took place yesterday and we go back there today, then the expectation is we're probably going to see some trading activity there. And that's why you'd want to mark it. Keep your bias out of it. Don't mark it as quote support, or if it was over our head as resistance. We have next week's range forecast here. It is just a forecast at this point. These lines will not be locked into place until after the close today. And in fact, right now they're still moving based on what's happening with price. So the gray line here in the middle, that is with our current price. As price moves up and down, so will that gray line. And these two lines are going to flex wider or more narrow as the day goes by. The week that we've had was broken. You can see how small and narrow it is. It was broken because it was a short week, but it was also broken because of OpEx. So it happens. The Thinkorswim indicators, they're janky to say the least. So if we wanted to compare this week to something, we'd want to compare it to 2 weeks ago, right? And if we do that, we'll see that the current forecast is much bigger than what we had 2 weeks ago. And that's not even just cherry picking either, because we could go, to another spot in June and still compare it with what we have. Even get into, some May price action. And it's still not matching what we see projected for next week. So they've got a high amount of volatility on the books for next week. A couple of ways to look at this. One, if it was something really big like FOMC, it would be volatility suppressing, right? That might not make sense at first blush, but if you think about FOMC, it's in the middle of the week. A lot of times we'll go sideways into that event. So Monday and Tuesday, we just chop about. We don't really do anything because everybody's scared and waiting on FOMC. So they say that FOMC is volatility suppressing. Well, it's not the only thing that's volatility suppressing. If it's CPI, PPI, non-farm payrolls, some big thing the market is worried about, a lot of times it suppresses volatility. We don't have that. We actually have a really wide range for next week. So whatever it is, it's not like an event where we are expected to hold the line and wait for something. It's something else. I don't know what it is at this point. I don't think anybody does. But the main takeaway is that we can see it. We don't have to guess or assume. We can straight up say the market is forecasting some increased volatility next week. Now, if you're not an options trader and you hear the things like volatility, might be a little confusing. Let's just remove all the nerd talk and put it in plain English. Volatility is another word for movement. So implied is another word for promised. Put that together. You got promised movement. If you have an increasing implied volatility, then you've got greater chances of movement. If you look at the way price behaves in good times, we get small candles, consistent size, consistent price, right? Just a nice, clean, organized, like ants, just very uniform and precise. We start getting in the volatility and we get big, large candles, big wicks, violent moves, multiple directions. That's what the market is pricing in, higher volatility. So it doesn't mean that we're going to get these big bars, and that doesn't mean down either. We can get big bars to the upside. And we could get nothing at all. It could just be another week. Just because they're pricing it in doesn't mean it's actually going to come to fruition and become a high volatility market. But they're pricing it in. They're expecting it for whatever reason. So next week, if you're running your the weekly mechanical trades, don't run a weekly iron condor next week. Maybe do like the Marcus trade, a double diagonal, right? That's a good one. And it should pay really well too, with the volatility in the front end being jacked like that, higher than the back end. We're still 3% above the 10-week. This is about as good as we could want it to be when it comes to our positioning. We're not overstretched. We haven't gone too far, too fast. It doesn't owe us any sort of mean reversion, and it's just a good, healthy place to be. We could stall out in the market for a month and not do anything at all, and the 10 would have time to come in to us nice and easy. So from that point, we're good. From the daily, maybe a little not so much, right? We're there. At this point, getting another reset to the downside would be nice. Think of like a slingshot. You got to pull it back to stretch it, right? Before you fire it off. So if we look at previous zones back here, we were just holding the line like we are now. And then we had a good dip. And then we were able to exceed this high into new highs because we were able to get below first. So getting below would offer us a nice shot back up. You'll often see that with the RSI Laguerre, right? We talk about the J hook. If you know, you know. So right now, we're right at the 10. Be really easy to break through the 10, get below it. We're not really in any sort of risk until we get, like 1% below the 10, and we're nowhere near that at this point. No reason to think we're going to get it today either. The base case is that we're just going to hold the line and go quietly into the weekend. And all things considered, that would not be a bad way to go. I feel like so far today, this has sounded pretty bearish. So I want to reiterate something really simple that 60-50, if we get above 60-50, we could easily run right back up into 6100, and we can test this high that we've already got here and build this out more as a megaphone pattern, right? The megaphone pattern being that we break the old high with a new high, and we break the old low with a new low, and that we just keep doing it, right? And it begins to widen out. we don't have to go sideways. And on a day where everybody expects us to go sideways, they could easily just slam it and push it to the upside, right? Like a forced grind higher. Sometimes this is referred to as forced buying. And there's a couple of different names for it, but that'd be the idea that whether they want to or not, they have to. I don't think we're in that situation because CTAs, I don't think they're forced to buy right now. We've got the end of buybacks. We're in the buyback blackout period. There's a lot of reasons to believe that we're not going to see it. Doesn't mean it can't happen. And even if we don't get all of that as a 0-day dynamic, we could just get options flow that slams us and forces the push to the upside and gets us above 6,100 anyways. So while I think we're going to go sideways, and I think that there's bigger threat to the downside than upside, if it wants to go up, then don't fight it and just keep playing it to the upside. I don't want to make this sound like it's all a big bearish bias. China's still down and not offering much over a 5-day period. Gold miners also down. It's a little odd, all things considered, with the war vibes and everything else. But, we were talking about that earlier in the week, that gold and silver, precious metals, they had already been doing good before the war vibes and before this whole thing kicked off. And then crude, of course, got the adrenaline shot and the pop to the upside on the war vibes, and so did the precious metals. The idea was they were going to suffer because of it, that they were going to, drop back down again. And that's what we're seeing in gold, silver, precious metals. But I wouldn't expect it to stick big picture. They're still bullish, right? They're going to suffer in the short term with the negotiation headline that we saw. We'll see gold fade, silver, crude. We got Bitcoin up 2%. And we got some China up, which is odd because we just had China down. So we've got some divergence in the China space. Emerging markets, that's China. Got a couple of others in here that are also China. And yet, looking at it on the other side, like here's yen, that's a China one, triple X bull. So those are positive China. But KWeb, that's a China one that I use a lot for China, and it's down 0.75% today and 2.5% over 5-day period. So a little bit of a discrepancy in this space. Emerging markets, we all just say that that's China, but really, it is a basket of stocks, and it's not exclusively China. And it is up a little bit, but it was down as much as KWeb, right? All things considered, this was down 2.5 and this was down 2.6. So suddenly it's doing its own thing. Same thing with yen. This is exclusively China. Was down 8%. Now it's in the green. So these could be early warnings of a heads up. BABA, Baidu, JD, PDD, XPEV, NEO, EDU. Those guys could get a nice flip to the upside. We've already got US chips and the Mag 7 trying to turn things around, head to the upside as well. They're not up enough, the benchmark being 0.5%. So things that are up at least 0.5%, triple X chips and Bitcoin. And of course, nat gas, trash. That'll just call that nat trash. It was almost like IWM knew ahead of time, huh? because now we've got the S&P and the NASDAQ and the rest of them in the green. All right, this is lining up to be a bullish morning. We got the Mag 7 nearly at 0.5%. And we got Bitcoin up. We just need to see the chips join the party. That's it. So on a day like this, breadth isn't necessarily going to be that big of a deal. Watching like the advancing versus the declining issues, things like that. It wouldn't hurt if you wanted to keep track of the total number of stocks that are, moving to the upside or the downside with money flow. Thinkorswim does a pretty good job of doing that. In the pre-market, a nice way to play this is just to look at, instead of what we were doing, which was looking at ETFs, look at the individual names themselves. So we take the S&P 100 and focus on how many names are up at least 0.5% and in what group. So it's kind of spread out. We're not seeing what we would want to see here, which is Mag 7 names, chips, cloud computing, that sort of stuff. So NASDAQ, only 14 out of 100 names are up at least 0.5%. Not enough, not even close. That's not bullish enough. And looking at the names that are in here, sure, we've got Tesla, but where's all the Mag 7? And they're not here. So we got chips, certainly Marvell, AMD, on. That isn't going to cut it. If you're looking for the S&P and the NASDAQ to break and make moves higher, keep your eye on the options market and or start focusing on getting some participation from the Mag 7. We got to get the juice from somewhere, right? Something's got to fuel this move. And if we don't get it, then the base case of just going sideways quietly into the close really holds logic, right? From Wednesday's high to our own low, GTFO. And I know that's a really big box, so just narrow it down like we did earlier. So what I got for you guys, be careful, be safe, watch the headlines and the clock. I'll see you all next week.